In today's episode of the Daily Brief, I'll talk about three interesting stories. I first talk about why the urban demand is slowing down. I then discuss some interesting details about why Maruti's budget car sales are falling. And finally, I talk about 6 big warnings from the RBI Governor. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to news channels. I'm your host, Akshara. Today is Thursday, 31st October. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcast. If you prefer video, you can listen along with interesting charts on YouTube. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our no spam newsletter for a quick rundown. All the links are in the comments. In today's first story, let's talk about a very important shift that's happening in India's consumer landscape. Urban demand for everyday products is slowing down, while rural areas are showing surprising strength and growth in spending. In a nutshell, big cities like Delhi, Mumbai, Bengaluru, etc., which traditionally drive much of the country's sales for daily essentials and luxury items, are now starting to see a decline in demand. On the other hand, smaller towns and rural areas, which are usually considered more budget conscious markets, are now emerging as fast growing sources of demand. Let's start by understanding what's really behind the urban slowdown. Like I mentioned, urban India has traditionally been the heart of the country's consumer spending. People in major cities tend to buy more, adopt trends faster, and are often drawn to branded goods. This made cities a prime focus for big FMCG companies like Tata Consumer Products, Hindustan Unilever, and Nestle, which relied heavily on urban demand to drive growth. But that urban demand is now showing signs of fatigue. For instance, Tata Consumer Products recently reported a softening in urban demand, pointing to food inflation as a significant reason. Rising prices for essentials like grains, fruits, and vegetables are stretching household budgets thin. When people have to spend more on basics, they're less likely to splurge on non essentials like premium snacks or personal care products. Nestle India's CEO, Suresh Narayanan, illustrated this trend with numbers. Growth in the food and beverage sector, which was once comfortably in double digits, has now dropped to just 1.5 to 2%. According to Narayanan, it's the biggest urban markets that are showing the most strain. But the question is, why are urban budgets tightening? See, both urban and rural India have felt the pinch of inflation, but urban households have been hit harder, especially with food costs rising steadily. Inflation in cities has made it tough for households to stretch their budgets, meaning that non essential purchases are the first to go. A recent Department of Economic Affairs report, the September Economic Review, confirmed this, noting that urban consumers are focusing on essentials, cutting back on other items. This shift is putting pressure on FMCG companies that traditionally thrived on robust urban demand. Put simply, people in cities are feeling the effects of rising prices and have become more cautious about discretionary spending. Meanwhile, rural India is offering a surprising contrast. Although rural demand isn't booming, it's steady and even expanding in some areas. Rural consumers are spending more on products that were once mostly purchased by urban buyers, including SUVs and larger packs of FMCG goods. Take Maruti Suzuki, for example. Traditionally, rural buyers preferred smaller, more affordable cars, but the latest data shows an uptick in rural SUV sales, a vehicle category once dominated by urban demand. This suggests a shift. Rural India is not only buying more, but is opting for higher value items, pointing to a rise in purchasing power. Maruti Suzuki noted that the rural demand for SUVs now accounts for 54% of their rural sales mix, underscoring this trend. FMCG companies like Tata Consumer Products and HUL have also reported similar changes, with rural consumers buying larger packs and showing more interest in personal care and snack products, breaking the stereotype that rural buyers are solely focused on budget items. Now, a few factors are driving this steady rural demand. First, favorable monsoon rains have boosted agricultural yields, which increases farmers' incomes, giving them more to spend. Second, government investment in rural infrastructure like roads and agricultural facilities indirectly supports rural incomes, strengthening purchasing power. We're also seeing rural and urban consumption habits start to converge. Where rural consumers once focused on smaller, basic products, they're now more open to premium items. As Maruti noted, this convergence in consumption patterns suggests that rural India is evolving from its image as a strictly low budget market. But that said, while rural demand is holding steady for now, companies are cautious. For FMCG players like Tata Consumer and HUL, rural demand isn't a guaranteed offset for urban slowdowns. Rural growth is heavily dependent on factors like crop performance, inflation, and continued government support. For example, HUL noted that while rural demand is stable, rural income growth and employment stability are essential for sustained spending, and these can fluctuate. Additionally, government support has played a crucial role in rural growth. With elections on the horizon, there's a possibility that policies could change. If rural focused spending is cut back after the elections, rural demand might lose some of its current momentum. So, although rural areas are becoming more influential, their growth remains sensitive to policy shifts and agricultural outcomes. So, in summary, we're currently witnessing a very interesting shift in India's consumer dynamics. Urban areas, which were once considered the powerhouse of consumer demand, are facing a slowdown, while rural India is stepping up with stable demand. This suggests a slow convergence in consumer behavior across regions. For us, this shift means that it's no longer fair to see urban and rural markets as completely separate worlds. Both urban and rural consumers will play crucial roles in driving growth, but only if rural incomes remain stable. This evolving landscape highlights an important message. As India's consumption patterns become more balanced, companies will need to adapt, ensuring that they cater to both urban caution and rural resilience in a shifting market. In the next story, let's dive into what's going on with Maruti Suzuki right now as per their latest quarterly results. India's biggest car maker, Maruti, holds more than a 40% share of the Indian passenger vehicle market. So, in some sense, Maruti's results and performance could be seen as a reflection of what Indian car buyers are thinking, their preferences, and even some of the struggles in the auto industry. Let's start by talking about the latest numbers for Maruti's Q2 FY25 results. First, Maruti's revenue this quarter stayed steady. Maruti's PAT for this quarter came to Rs 3,692 crore, which is a 17% drop from last year. Now, you might be wondering why profits fell while revenue was still similar to the previous quarter. See, the dip this time around wasn't only because of weak sales. It was also partly because of a one-time tax expense due to recent changes in the tax rules under the Finance Act. But back to Maruti's car sales. If you look at it by volume, sales also fell slightly this quarter. The total number of cars sold dropped by 1.9% from last year, with domestic sales specifically down by 3.9%. To some of you, this might not sound like much, but for Maruti, whose growth has often been fueled by selling entry-level affordable cars, this dip is a signal of something deeper. See, historically, Maruti's entry-level cars like the Alto and WagonR have been the foundation of its sales. These cars are meant to appeal to first-time buyers and budget-conscious families, making them a big part of Maruti's success. But things seem to be changing now. This quarter, Maruti reported that sales in its mini and compact segments were down by around 15% compared to the previous year. According to Maruti's chairman, R.C. Bhargava, rising car prices have made entry-level models less affordable for many buyers. Bhargava pointed out a notable fact. Back in 2018-19, lower-cost cars made up around 80% of the market. But today, they're less than 50%. Essentially, fewer people are buying budget-friendly cars, and Bhargava expressed concern that if this segment doesn't grow, it could eventually affect sales in higher-end models. Entry-level buyers often trade up to pricier models later, so a shrinking budget car segment could impact Maruti's long-term sales potential. But that said, while entry-level cars face headwinds in today's market scenario, Maruti's SUVs are holding steady. This quarter, utility vehicles or UVs, which include models like the Grand Vitara and Fronx, made up nearly 39% of Maruti's domestic sales. This segment grew slightly by 0.3% year over year. SUVs are popular with buyers, not just because of their size and durability, but also for the status that they convey. Recognizing this demand, Maruti has strengthened its SUV lineup to meet buyers' expectations for larger vehicles. What's also working in Maruti's favor is that SUVs come with higher price tags on average, meaning they contribute more revenue per vehicle compared to smaller cars. According to Maruti's management, this shift to SUVs is helping the company weather the challenges faced by entry level segments. Now, while on one hand, Maruti's entry level cars are struggling, its CNG models are doing pretty well. To give you a sense, 1 out of every 3 cars Maruti sold this quarter was CNG powered. This is significant because CNG or compressed natural gas is cheaper and more stable in price compared to petrol or diesel. This makes it an attractive option in a market where fuel costs can be a bit unpredictable. With 14 CNG models, Maruti now has the widest CNG lineup in the Indian market, appealing to customers looking for economical and environmentally friendlier options. Also, despite softer domestic sales, Maruti's exports have shown promising growth. Export sales went up by 12% this quarter, driven by demand for models like the Francs in countries like Japan. This international demand provides Maruti with a cushion against weaker sales in India, especially in the entry level segment. Even though Maruti is seeing growth in the SUVs, CNG models, and exports, there's pressure on profit margins. To keep sales up, Maruti has had to increase discounts on its vehicles. On average, the per car discount went up to Rs 29,300 from Rs 21,700 last quarter. These discounts are crucial to attract buyers but directly affect profitability. On top of that, rising costs for raw materials make things even more challenging, although Maruti has managed this partly by controlling its inventory and keeping other costs in check. Finally, there's Maruti's electric vehicle or EV strategy. Maruti is planning to launch its first high spec electric SUV next year, which will be built from scratch as an EV and equipped with a 60 kilowatt hour battery. This model will target both the Indian and international markets, especially countries like Japan and parts of Europe. This is a significant step for Maruti, showing that it's serious about entering the EV space, a segment that could be key to the future of the auto industry. Additionally, Maruti is teaming up with Toyota to produce its first electric vehicle for Toyota in India, with production set to start in 2025 at Maruti's Gujarat plant. This partnership also involves Daihatsu, reflecting Maruti's strategic approach to EVs by collaborating to benefit from shared expertise and production scale. So, where does Maruti go from here? The big question here is whether the growth in SUVs, CNG models, and exports will be enough to offset the slowdown in entry level cars. If Maruti's strategy pays off, the company could maintain its position as India's automotive leader despite the challenges in the lower cost car market. But if entry level sales continue to weaken, Maruti's long term growth could be at risk. In the next story, let's discuss a speech that RBI Governor Shaktikanta Das recently gave at the Peterson Institute for International Economics. His speech covered 6 major issues that are reshaping global finance and affecting economies worldwide. Each point is both complex and crucial for us to know as investors and people who track the markets. So let's break them down one by one. Number 1, reforming global financial institutions. Governor Das started by discussing institutions like the International Monetary Fund or IMF and the World Bank. Now, these organizations were originally designed to help countries in times of economic crisis and to keep global financial systems stable. But here's the issue. They were set up over 75 years ago, and their structure still reflects a world where developed nations have a bigger influence and control. Emerging markets, meanwhile, have grown massively in size and importance. They need a larger say and better access to these institutions' resources. The current imbalance means that it's harder for these economies to get the financial support they need, which can have a knock on effect across global markets. Governor Das suggested a solution. Give emerging economies more representation and influence within the IMF and World Bank to reflect today's global economy. Otherwise, he warned, these institutions risk becoming less relevant and effective in managing modern financial challenges. Number 2, the global debt crisis, an urgent concern. The second point he made was about the global debt crisis. In simple terms, debt can be helpful if it's used well. But when a country can't manage its debt, it becomes a huge issue. Recent efforts by the G20, like the Debt Service Suspension Initiative and the Common Framework for Debt Treatments, were aimed at helping struggling countries. However, these measures are temporary fixes, not long term solutions. The real problem, according to Governor Das, is that the current system for dealing with debt crisis is slow, unorganized, and often lacks transparency. There's no efficient, streamlined process to help countries in severe debt, which only adds to their economic strain. His suggested approach includes bringing both public and private creditors to the table, speeding up debt restructuring, and aligning debt relief with sustainable development goals. Without this kind of overhaul, vulnerable nations could remain trapped in debt, creating risks for global economic stability. Number 3, fragmenting global economy. Governor Das then touched on a growing trend, the fragmentation of the global economy. In a sense, countries are trading less with each other, partly due to new restrictions and geopolitical tensions. The IMF estimates that these trade barriers could cost the global economy about $7.4 trillion over time, which would obviously impact everybody. This fragmentation means that countries are starting to friendshore and reshore, focusing more on trading with allies and moving production back home. But as this trend grows, financial institutions feel the pinch too, facing higher costs and lower profitability. Emerging economies, which rely heavily on trade, will need to bolster their financial reserves to withstand the shocks caused by a less connected world economy. Number 4, the digital and financial divide. As the world becomes more digital, there's a widening gap between countries that are set up for the digital economy and those that aren't. Digital infrastructure like high speed internet, tech regulations, and skilled workforces is crucial for participating in the modern economy. Governor Das also pointed out that the financial system itself is evolving with new players like fintech companies, shadow banks, and decentralized finance or DeFi. These groups hold a significant portion of global assets but aren't as regulated as traditional banks, which can create financial risks. He argued that stricter oversight is needed to ensure these emerging sectors don't disrupt the economy, particularly in developing countries with limited regulatory capabilities. Number 5, climate change and central banking. One of the more unique points he raised was about the connection between climate change and central banking. As climate events like floods, wildfires, and droughts disrupt economies, central banks have to consider climate risks when planning for financial stability. These events can affect prices, production, and overall growth, which central banks traditionally monitor. According to Governor Das, central banks have 4 key roles in tackling climate risk. Number 1, managing price stability. A low carbon transition can impact prices, so central banks need to account for that. Number 2, protecting financial stability. Climate related disruptions can have ripple effects on the entire financial system. Number 3, supporting financial institutions. Central banks can help banks and other financial companies manage climate related risks. Number 4, driving research and awareness. Contributing knowledge and raising awareness on climate risks. In India, the RBI has already taken some steps in this direction, like promoting green bonds and renewable energy projects. But central banks face a tricky balancing act. They need to act on climate risks without going beyond their legal powers. Number 6, India's economic performance. Finally, Governor Das shared in an optimistic view of India's own economic trajectory. Over the past 3 years, India has averaged over 8% real GDP growth, and the RBI expects around 7.2% growth for 2024-25. This growth has been driven by strong domestic demand, supportive policies, and a resilient services sector. Inflation remains under control for now, but the RBI is working to bring it even lower, aiming for a 4% target. That's not without challenges. Unexpected events like extreme weather or geopolitical tensions could disrupt this effort. But for the moment, India's outlook seems solid, especially compared to some global peers. So, in summary, Governor Das's speech was a call to action on multiple fronts, highlighting areas where global financial systems need modernization and stronger collaboration to handle today's challenges. From rethinking the IMF and World Bank's roles to addressing the global debt crisis, he pointed out that it's time for the world to make some tough adjustments. Tackling the digital divide, climate risks, and economic fragmentation will also require more cooperation and forward thinking policies. Now, moving on to the last segment, tidbits. Number one, Amazon India's units reported mixed financial results for FY24, with Amazon Pay leading revenue growth at 9.2% and net losses reducing by 39%. Despite regulatory and market pressures, Amazon's growth in digital payments and logistics signals strategic focus amidst a challenging landscape. Number two, to meet SEBI's 25% public shareholding requirement, Adani Enterprises paused its Adani Wilmar demerger plans. With Adani Group's strategic shift towards sectors like green hydrogen and infrastructure, this move could unlock new growth opportunities aligned with India's economic priorities. Number three, despite a 9-month pause in onboarding, Razorpay's revenue grew 24% to rupees 2,068 crore in FY24, reflecting strong resilience in the face of regulatory hurdles. With its rapid onboarding post-approval, Razorpay's adaptability reinforces its position in India's digital payment sector. Number 4. RBI has directed Warburg Pincus to reduce its stake in Home First Finance to below 20% before proceeding with its acquisition of Shriram Housing Finance. This move underscores RBI's focus on maintaining competition and preventing excessive control in the housing finance market. Number 5. India's credit card spending surged by 25% year on year in September, reaching rupees 1.76 trillion, driven by festive promotions and EMIs. While spending momentum remains strong, banks are cautious, noting early stress signals in credit segments as consumer debt levels rise. These were today's big stories. I'm Akshara, and this was the Daily Brief. See you in the next episode.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.